This one concept can be the difference between retiring early and being penniless. Compound interest is incredibly powerful, and as an investor, you need to make it a priority. Dividend investing has a compounding effect, especially when you are reinvesting your dividends back into your stocks. This creates a snowball effect that in the long term can help you build generational wealth. In this video, I'll share a model of dividend growth that lets you see the full power of dividend investing. Dividend reinvestment can be your path to financial success. When calculating interest, there are two main choices. First is simple interest, where you'll calculate a set percentage of the loan's value each year. The second is compound interest, which means that additional amounts will be added to the money already owed. The difference between simple interest and compound interest is the way the interest accumulates. Simple interest accumulates only on the principal balance, while compound interest accrues to both the principal balance and the accumulated interest. With a simple interest account, if you invest $1,000 at a 5% simple interest for 10 years, you can expect to receive $50 in interest every year for the next decade. One good example of an investment that provides this type of certainty is bonds. On the other hand, compound interest is a form of investment where you reinvest your earnings and then those earnings also earn interest. These reinvestments are what make it possible to get higher rates of return. Compound interest essentially means interest on the interest. This is one of the most successful measures for investors. Think about it in this way. Let's say you invest that same $1,000 at 5% interest per year. After the first year, your account will be credited with the $50 in interest. You could take that money and put it in your pocket, or you could reinvest your newly accumulated interest back into the account at the 5% annual interest rate. If you decide to reinvest that, your third-year interest will be calculated on $1,102.50. This is how compound interest works. It means that your principal, and the interest it generates, gets larger over time. The difference between simple and compound interest can be massive. Take a look at the difference on a $10,000 investment portfolio with a 10% interest over time. Another similar concept is called cumulative interest. Cumulative interest refers to the sum of the interest payments made on a loan, but it typically only counts payments made during a certain time frame. For example, the cumulative interest on a 30-year mortgage would be how much money you paid toward interest over the 30-year loan term. Compound interest, which is how you calculate the interest on your investments, or the rate of return for any project, is calculated by multiplying an exponential growth factor to the rate or rate of return you're using. To calculate compound interest over a certain period of time, here is a mathematical formula you can use. Where A is the final amount, P is the principal, R is the interest rate expressed as a decimal, N is the compounding frequency, and T is the time period in years. Your principal refers to your initial balance of an investment, also known as its starting value. The term is typically used in the context of a loan, but it can be applied to investments too. You should think about your $10,000 investment for the next 5 years as a principal for calculating compound interest. The rate you set will be the interest rate or expected rate of return, expressed as a decimal. For calculating purposes, if you want your investment to grow at an average of 7% each year, you use 0.07. Compounding frequency refers to how often you're adding interest to the principal. With a 7% annual compounding, you would add 7% automatically once per year. On the other hand, compounding interest on a semi-annual basis would involve multiplying 3.5% by the original principal twice per year rather than just once. Other common compounding frequencies include quarterly, which would be 4 times per year, or monthly, even weekly, or daily. There's also a mathematical concept called continuous compounding, where interest is constantly accumulating. Time concept is easy to calculate for compound interest. All you need to do is use the total time in years and months. If you are investing for 30 months, then 2.5 years would be the total time. In this previous example, we were using annual compounding, meaning that the interest was added only once a year. In practice, interest is often calculated more frequently, with intervals being quarterly, monthly, daily, and even multiple times per day. The frequency of compounding makes a huge difference. Generally, the more frequent your interest is compounded, the faster you'll grow. For example, $10,000 at 8% interest compounded on one time every year will reach $21,589 in 10 years, while $10,000 at a monthly compounding rate will reach $22,196 in the same time period. As a basic example, imagine that you're investing $20,000 at 5% interest, compounded quarterly for 20 years. If this is the case, then N would be 4 since quarterly compounding occurs 4 times per year. Doing the calculations, we can see that the investment's final value after 20 years would be $54,029. Compound earnings refers to the compounding effects of both interest payments and dividends as well as appreciation in the value of your investment over time. The difference with compound interest is that it just focuses on the compounding effects of just the interest. Imagine if you were getting a 4% annual dividend return on your stocks, but the stocks themselves increased by 5%. That gives you a 9% return for the year. When you reinvest your dividends, it becomes a form of compound earnings. This means that not all of the gains came from interest payments to you. In a nutshell, if you are looking to invest in stocks, ETFs, or mutual funds long term, their total earnings over the course of an investment's life is called compound earnings. You can also apply this formula if you know your expected rate of return. Compound interest is an excellent way to save. If you allow your investments to grow and compound for a long period, this can provide an organized source of money for your retirement. Remember that the power of compound interest is so much greater over a long period of time. So how do you get rich? With compound interest starting off with a $1,000 initial investment, we'll look at the Vanguard 500 Index Fund ETF, ticker VOO. Over the last 5 years, it's up a total of 78%, with a 5-year average of 15.6% rate of return. We'll look at the difference between 20 years, 25 years, and 30 years. If you were to open a retirement account, either a standard IRA or Roth IRA, the max contribution a year is $6,000, or $500 a month. Monthly contribution of $500 a month, or $25 per workday, Monday through Friday. With the power of compound interest, after 20 years, we have a combined total of $631,000. If we were to keep investing for an additional 5 years, we would have a combined total of $1.3 million in total savings. And going one step further, after 30 years, we would have a combined total savings of $2.6 million. These examples, we are compounding the interest on an annual basis. It's important to remember that your results may vary due to market conditions, as well as taxation. Luckily, if you were to invest your savings in a Roth IRA, then you can shield your investment from taxes. I hope this video inspired you to start investing and experience the snowball effect. Please check out and subscribe to my blog at supernovastockwatch.com. Thank you for making it to the end of my video. Please check out my other videos and also check out the description for great deals and sign-up bonuses.